Good day, my name is Adrian Meager, and today I'll be discussing the global and South African equity performances for July. In the US, S&P hit a new high in July, despite losing some ground towards month end, but still ended higher by 2.2%. The Nasdaq closed the month higher by 3.7%, while the Dow ended the month higher by 0.1%. If we look at the economic front, US June headline inflation, as measured by CPI, accelerated to 2.7 year-on-year versus the May print of 2.4. White core, which excludes food and energy, printed at 2.9, which is also up slightly from 2.8 in May. The US economy is expected to grow by 2.1% in 2025, led by strong consumer demand, solid labor markets, and elevated household savings. US equity valuations are elevated, with the S&P 500 trading at about a 22 times forward earnings. But there's a sharp disparity between the top 10 stocks and the rest of the index, as well as between growth at 27 times and value 17 times, highlighting growing concentration risks. Investors' positioning remains concentrated in the mega cap tech sector, while small caps and value remain under-owned. European markets had a strong July as trade tensions, mixed economic data, as well as geopolitical risks continued to weigh. The DAX rose 0.7, while the CAC was up 1.7 for the month. On the economics front, inflation in the Eurozone for June printed at 2% year-on-year, compared to the 1.9% print in May, and in line with the ECB's 2% target for inflation. Core inflation for the period remains unchanged at 2%. Eurozone growth remains weak and uneven, with a modest stabilization in 2025, driven by real wage gains, lower energy costs, and improving tourism in Southern Europe. However, structural challenges, tepid consumer demand, and poor external demand continue to weigh on the outlook. Europe is seeing net negative earnings revisions, while credit growth remains subdued amid tighter financial conditions, weak capital expenditure, and cautious corporate investment behavior, signaling a mid to late cycle environment. The ECB delivered a rate cut, but signaled caution ahead. While European equities are relatively cheap, they traded about 13 times forward PE versus that of the 20 of the US. However, the return on equity is lower. Sector composition and underrepresentation in growth areas diminish their appeal. Europe is underperforming on a relative basis, with deteriorating technicals, negative earnings momentum, and lackluster fund flows. Investors' position remains neutral to underweight, with global allocators back to favoring US and Japanese equities over Europe. In the UK, the FTSE 100 rose by 4.2% for the month, as UK inflation accelerated to a higher than expected 3.6% year-on-year, compared to the 3.4% printed in May, with core inflation rising to 3.7% year-on-year versus that of 3.5% in May. Asian markets trended higher. In China, the Shanghai Composite Index climbed by 3.7%, with the Hang Seng up by 2.9%. This was largely driven by China's stimulatory efforts and greater infrastructure spend. On the economic front, Chinese GDP jumped 5.2% year-on-year for the second quarter of 2025, printing slightly ahead of market expectations. The Japanese market ended higher by 1.4% for the month, with headline inflation declining to 3.3% year-on-year, compared to the May print of 3.5%, which was in line with expectations, but still above the Bank of Japan's 2% target. Japan's 2025 real GDP growth is projected at 0.8%, slightly lower due to soft exports and subdued capital expenditure amid global trade uncertainty. Nonetheless, domestic demand remains resilient, underpinned by a 5.3% base wage increase, stable employment, and easing financial conditions. The yen has stabilized, and equity market performance is increasingly driven by underlying earnings strength rather than currency moves. Earnings per share growth is expected to hold at about 5.5%, 6%, with robust contributions from financials, insurance, and IT services, balancing ongoing weakness in autos and machinery. Valuations in Japan remain compelling, with the market trading at about 14 times earnings, below its historic average, and about a 30% discount to the US and a 10 to 15% discount to Europe. The market is now earnings-led, with positive revision trends and rising domestic and foreign investor interest. Low foreign ownership highlights ongoing re-rating potential within global allocations to Japan. Okay, now moving to South Africa. The JSE All Share Index breached the 100,000 level in July for the first time and closed the month up 2.2%. Resources were the leading light, up 5.1% for the month, followed by property up 4.4%, financials up 1.4%, and industrials up 1.1%. The best performing shares for July were Adcock Ingram, which is up almost 37% on the back of takeover announcement by India's NACO Pharmacy. Sasol was up 19%, Sibanye up 18.9%, British Mint Tobacco up 15.8%, Telkom up 10%, and Northern's up about 9.4%. As anticipated, the South African Reserve Bank Monetary Policy Committee unanimously cut the repo rate by 25 basis points. The decision was driven by subdued inflation readings and falling inflation expectations. The MPC also announced that while the official target range remains 3 to 6%, as mandated by National Treasury, the SARB has revised its preferred inflation downwards from 4.5% to 3%. As the global economic cycle matures, success will depend on active risk management, tactical and flexible asset allocation, and a keen focus on emerging structural trends. Vigilance in monitoring policy shifts, trade developments, and macro fundamentals is crucial. By remaining disciplined, adaptive, and forward-looking, investors can better navigate volatility, capture selective growth opportunities, and protect long-term wealth in an uncertain global environment. Thank you. Until next time, goodbye.